Hi, everyone. My name is Michael Karsa. Welcome to 2021, Everything You Haven't Thought of Yet. The team here at Lido is very excited for a collective discussion today. But just in terms of some basics to lay out, for those who don't know me, I'm one of the senior managing directors of the firm, leading the charge out of Chicago and really focusing on clients throughout the Midwest. During these uncertain times, we feel investors need guidance, right? And that's actually just personally what brought me into the industry. Living through 2008, seeing my parents, family members go through the financial crisis, and really not having that, indispensable resource to turn to. And I wanted to be that person for them going forward. And things continue to change and evolve since then. We saw in 2020, the fastest 30% drop ever in the history of the stock market, and plenty of uncertainty heading into this year. Wildness in the markets with what happened, with GameStop, AMC, never seen before. What we saw with Tesla over the last year, and those are some few of many examples. And so, we feel navigating these markets along with the proposed changes, in tax and estate law, is really essentially exactly why we have these experts at Lido and on the panel today. So one thing just to note before we kick things off, you should be able to find a Q&A button within the Zoom application. Any of the attendees, feel free to fire away any questions as we go throughout, and we will look to answer as many as possible before we wrap up today. And without further ado, I'd say it's a great jumping off point to introduce the panelists. Mr. Greg Kushner, would you like to start?
Oh, sure. Thank you, Mike. And thank you, everybody, for participating in our webinar today. We've got lots of great information from our team here, and maybe just a little quick background on myself and our firm for those of you who don't know me. I am the CEO and founder of Lido. It's been quite a ride over the last 20 plus years, now managing over $7 billion for clients. And of course, that's a big responsibility that we take very seriously, as you just heard Mike say. Having that indispensable resource for or being that indispensable resource for our clients is really what I think Lido is all about. I'm actually a CPA by background. I don't practice as a CPA any longer, but I'll tell you that background in doing personal financial planning for high net worth individuals earlier in my career has really helped me as we built out our firm over the years. And it's really important to understand comprehensive wealth management versus money management. And that sounds kind of the same, but at Lido, we're trying to provide a very comprehensive approach to wealth management. And that's why we have an estate planning attorney and a CPA on our panel with me today, because we're going to talk about the entire package of financial planning and how that interplays with your investments. So I'm very excited to be here and looking forward, Mike, to hopefully answering a lot of questions from our audience. So thank you. I'm going to turn it over next to Jenna and let Jenna introduce herself.
Hi, everyone. Really nice to meet you. My name is Jenna Glasek. I lead up the estate planning endeavor here at Lido. I did not start my practice in estate planning. I was in complex commercial litigation at a big firm, similar to Mike's experience saying watching his family go through things being an inspiration to him. I was in big law, and my mom passed away at my first year as an attorney, and I spent the next 8 years in probate court on her estate. It cost time, it cost money, it cost emotional upheaval in the family. And so I transitioned practices to estate planning specifically to help people avoid that experience and to help people take what they've worked so hard for during their life and create this legacy for their family going forward. Lots of exciting stuff happening this year, some exciting changes, some less exciting changes, but lots of good stuff for us to talk about today. And I'm going to turn it over to John to introduce himself.
Hi, everyone. Thank you for joining us today. I'll give you a brief background about myself. I'm a director here at Lido. I started my career in Manhattan as a credit analyst for 3 years. I then transitioned to tax accounting. I became a CPA, practiced in Manhattan for another 3 to 4 years. And then I took over an accounting practice in the suburbs of Manhattan. Some of you may have heard of the Catskills. So I ran an accounting practice up there for 12 years. We did tax preparation, tax consulting, and business consulting. Now I am happily at Lido Advisors. Here I'm doing tax mitigation strategies and portfolio management for ultra high net worth. And thank you again for being here today. Michael?
Well said, John. We're happy to have you as well. I'm happy to have all three panelists on the team. So let's kick things off then in terms of some of the questions here. So Greg, I'll start with you. Today's discussion around wealth planning, it's very much going to cover a wide spectrum of topics. The term comprehensive wealth planning is oftentimes thrown around in the industry to describe services offered to a client. So when you consider comprehensive wealth management, what are some key attributes in the process?
Mike, that's a really important concept. And before I founded Lido, I worked for a very wealthy family called a family office, for those of you who are familiar with that term. And in a family office, it's really all about comprehensive wealth planning. It's making sure that estate planning and tax planning and the investments and liability insurance and life insurance, anything and everything that has to do with your financial well-being are looked at kind of from a 30,000-foot view, as well as then on a more micro view. But the point is, a family office makes sure that all aspects of the financial lives of the principals are being well cared for. And so at Lido Advisors, what I saw was that many investors were only having their investment person deal with their investments. Then they had their accountant deal with the tax issues and their lawyer. And there wasn't this comprehensive approach. And to me, I really saw that as a shortcoming of the more traditional Wall Street type firms. And so Lido was really founded to be our client's family office. Whether or not you have $1 million or hundreds of millions of dollars, it doesn't really matter. You need to have somebody who understands all aspects of their wealth. And that's why I think one of the reasons we've done so well and been so successful with clients over the years and have such a great retention level is that we do understand kind of all aspects of a client's situation. Now, obviously, we focus on investing at Lido Advisors, but we make sure that all those other aspects of their wealth are covered as well. So I think that's a key driver that everybody that's listening today and watching, should understand. Has anybody looked at their estate plan and their investments and their taxes in a comprehensive way? And that's really important.
Well said, Greg. And I'd say just to take that one step further, at least on the investment side, is, how many times, we're sitting down with clients that just this week, I've had multiple conversations around where we see that traditional, 60-40, portfolio. And, at the end of the day, it's a 60-year-old investment philosophy. And, the conversation I'll have with clients is, what do you still use today that's 60 years old? Right? I'd assume the list is fairly short to non-existent. So in a way, we're challenging the status quo at Lido, both in terms of incorporating the tax and estate planning, but when it comes to the investments alone, why manage your life savings, millions of dollars, simply following, a 60-year-old approach? And those, I'm sure, things and topics that we'll further explore today. But on the, while we're talking about beyond just investments and taxes, John, I'm going to throw it to you. Given the new administration, there's a long list of proposed tax changes. Plenty, I'm sure, we'll cover today. But for you, what's top of mind is, the top one or two potential changes, that high net worth investors should be aware of?
Thank you, Mike. I think I'd preface my comments by saying that change is inevitable, right? So, and I think the changes are likely to be complex. And the reason I say that is because of budgetary reconciliation. I'm sure everybody knows in 1974, Congress offered up the idea of reconciliation. And basically what that is in a nutshell as relates to tax law is the House Ways and Means Committee will offer up tax legislation and it'll be approved or not approved by the Senate. Because of reconciliation, a simple majority can push through tax reform as opposed to supermajority. So the first point I wanted to make is that there's inevitability, right? The second thing is that it's likely to be comprehensive and complex because there's going to be a bipartisan element. So the importance of tax planning is paramount this year. The couple of areas that I think are going to affect us most are for taxpayers with over 400,000 of adjusted gross income. Rates are likely to go, max rates are likely to go from 37% to 39.6%. As it relates to cap gains for investors over $1 million in AGI, it's likely that cap gain rates go from 23.8 to 43.4, an 80% increase. That includes net investment income tax as well. It's a massive tax increase for the ultra wealthy. We need to be mindful of that. The third area is estate and trust. If a estate tax or death tax goes back to the late 1700s, but if I look beginning in 2001, the estate exemption was 675,000. If I look at the trajectory from 2001 to 2010, it's relatively predictable. You know, the increases are, I would say, obvious and predictable relative to inflation and other things impacting our markets. But we had a major jump to 5,000, and then we had another major jump to over 11,000 in 2017.
11
I think
million.
it's highly, what's that?
11 million, not 11,000.
11 million, I'm sorry, 11 million, and now we're at 11,700,000 in 2021. As we do our analysis, we think it's very likely that we roll back to either 5,000 or 3,500. And the two things that occur to me as it relates to that, there's more and more people that are attending this call today that are going to be impacted by estate tax. There's more and more of your friends and family that need to be attentive to trust work and estate and tax planning. So I think that's my view from 30,000 feet as it relates to what I think is going to be happening here shortly. I would say the end is likely 5,000 to 5 million to 3.5 million. And I think Jenna can touch on this as well, but I'm imagining we're on the same page as it relates to this.
John, one follow-up for you in terms of things like the capital gains rates going up. Do you see something like that being retroactive or just more on a proactive basis going forward if it were to pass? Is there a precedent on that?
Right. So the Congressional Budgetary Act of 1974 set in place reconciliation, as I mentioned earlier. Reconciliation has been used 25 times. 5 times the tax code changes were retroactive. Undersecretary to the Treasury in the tax area, Mr. Mazur, pointed out that it's unlikely in his view that the code changes will be retroactive to January 1st, 2021, but we need to be cognizant of the fact that it has happened in the past.
And one of the things we've seen in the past too, John, is that, let's say they enter the bill on, let's come up with a date, March 19th. I've seen in the past where they'll make the effective date, the date that they brought in the proposed legislation. So even that could be a very fast timeline if they do something like that. We're all hoping, of course, that it's not a 2021, but a 2022 change, so that it gives all of us in the planning world opportunities to help our clients kind of navigate through. But it's certainly going to be a challenge, and I think everybody is in agreement on that point.
Yeah, I would thank you, Greg. I would make one other point. The Congressional Appropriations Act of December 20th put forth 20 changes and 30 extensions. The anticipation for the Biden tax change is another 25 to 30. That's 75 to 80 changes that are likely from December 20th. This is a time to plan, and this is a time to be vigilant.
And speaking of planning, there's plenty to plan for on the transfer tax, the state law side of things. And Jenna, can you elaborate on your side and what you're seeing, proposed changes and things to be considering proactively? Absolutely.
I agree with John entirely. I think the most confident thing I can say is I think the estate tax exemption is going down. I agree. I think 3.5 to 5 million is probably the range we're looking at. That I'm pretty sure of. Right now, the estate tax on anything above the exemption amount is 40%. That could go up to 45 or 50. And again, we don't know. I think it's most likely to kick in January 1st of next year. Second most likely, as Greg said, on the date it passes. Least likely, as John was saying, retroactive, but any of them is of course possible. So decreasing the exemption, I think, will definitely happen. Increasing the rate is possible. We might also lose stepped up basis. So right now, under the laws, it says that when somebody passes away, the basis of their assets marks up to market value at date of death. So that means basis is typically what somebody bought it for. If they sell it, they owe capital gains tax on the difference. If they pass it on at death, then it marks up to market value. So if we take real estate as an example, I have a lot of clients talking to me now about real estate transfers. Parents bought it, 30 years ago for $100,000. It's worth $2 million now. Their basis is $100,000. If they sell it, they're paying capital gains tax, which in California is going to be about a third of that difference between 2 million and 100,000, so 6-something million in capital gains tax. If they keep it in their estate and then pass away and pass it on to their beneficiaries, the beneficiaries sell it the next day. Basis is market value at date of death. They sell it, no capital gains tax. So that's a huge tax benefit for people holding assets in their estate. We might lose it. It's on the chopping block. We just don't know. So if we think about it, at a 20 million, if a person has $20 million estate right now, their estate tax exposure is about $3.33 million with that $11.7 million exemption. If it goes down to 5 million with a 45% tax rate, so that's kind of the most conservative option I think might happen, it pretty much doubles their tax exposure to about $6.75 million. So these are really consequential changes that are happening. And that doesn't mean we have to sit around and just wait to pay that tax. There's a lot of options we're putting into place now. Sooner is better because of course it could be effective as of date of passing. We think we have the year, but there are things we can do to take advantage of that 11.7 million exemption we have before we lose it. The IRS has said that if you gifted out $11.7 million this year, and then you died next year when the exemption is 5 million, they won't claw that extra money back into your estate. So it means we have this short-term opportunity right now to use as much of that exemption as possible. And that doesn't mean just gifting out assets to a bunch of people. There are trust structures we use for this purpose. There's endless numbers of trust structures, and we try to pick the ones that are best tailored to the amount you feel like you need to access these assets for your standard of living, how much control you want to have over them. There's lots of options. A SLAT for married couples, a spousal lifetime access trust, is a great option to keep it out of both you and your spouse's estate while still having a good amount of access. So really, what you should be doing right now is talking to your advisor. Talk to your estate attorney if you have one you use that you're comfortable with. Loop Lido in. If you don't, or even if you do, I can get involved, help strategize. I can actually show you quickly something that we can do for clients, compliance language, that's very important, but we can put together a strategy after talking to you. What are your goals? What's your current plan look like? And here's some recommendations. Here's some things based on your specific situation that we think you should think about. You should talk to your attorney about, talk to your advisor about, have us all in the loop, and start planning now because, time is definitely of the essence on some of these things.
Well said, Jenna. And I really want to just take a pause and make sure everyone's writing this down because to your point, just based on some conservative changes, it could mean doubling the overall tax impact from an estate standpoint. So again, talk to your Lido advisor, whether it's getting them connected or getting you connected with Jenna directly or having Jenna speak with your current estate attorney. This is really something that should be addressed as soon as possible before these changes do be put into place. So to keep things moving on and get back to some stock market talk, a lot of the big names reported earnings last week, those tech giants, and based on your typical or standard fundamental analysis, we're seeing valuations never seen before. So Greg, throw it back to you. How does an investor confidently invest in today's markets?
Well, Mike, it's something I've been doing this an awfully long time, and I say this, it seems like every year, and I'll say these words. It really seems like this is the most difficult time ever to invest money. But I seem to be saying that just about every year at this time of year. And I think this year is certainly no exception at all. When you look at the valuations at the stock market, When you look at prices of real estate, you look at bonds, interest rates at virtually all-time lows, making bonds very expensive. There's really no free lunch, if you will. There's really no, hey, that's an obvious opportunity to invest. And so as such, you really have to be careful, and you have to be quite circumspect on how you're allocating money today. You had mentioned the 60-year-old methodology, the modern portfolio theory. For those of you who are not quite familiar with that concept, it was a Nobel Prize winner back 60 years ago came up with this concept of asset allocation and risk. But to me, just simply setting it and forgetting it, which is kind of the modern portfolio theory, it just doesn't make any sense. You have to be opportunistic and take advantages of what the market is giving you. To me, we are absolutely in that situation right now where there is going to be much more of a disparity between winners and losers. Over the last number of years, it's been pretty much an index type of market where if you're in the index or in the right index, you've done well, especially if you were in the larger cap names. But there's much talk of rotation into other names that have been less visible and less successful as far as price movement. To me, I think having a very well diversified portfolio with assets that can move irrespective of the stock market and hold up well even during a downtime. We saw this in action in March, right? As on the March 23rd low of the market, Lido portfolios performed incredibly well. And why was that? Because we had options where we had hedged portfolios. We had a lot in lending against real estate that clipped along and still generated the nice returns that we've been getting for a decade. We've done things that provide non-correlation, and those are words that kind of in the investment world people talk about all the time. But in a crisis situation, like we saw in 2008 and like we saw during the pandemic, the worst of it early part of last year, everything has a correlation of 1. In other words, it seems like if you think you're diversified by having money in large US companies, mid-sized, small companies, international stocks, that doesn't really help you because everything went down together. And so you need to find ways to hedge your bets a little bit, have things that are going to hold up. And to me, as our chief investment officer, Jeff Garden, always talks about, it's probabilities. The number one question that I get from clients, and I'm sure, Mike, you get these as well from your clients, and that's what's this disconnect between Wall Street and Main Street? Wall Street, the market's hitting all-time highs, and yet we have, all the impact of the pandemic. And so you just have to be careful and make sure that you've structured your portfolio in a way that's very opportunistic. And that's something that I'm very proud of that we've done at Lido over the years. In 2012, 2013, we started buying distressed real estate. That was the opportunity. In 2020, there isn't nearly the same kind of opportunity. So you have to find different ways to make money for your clients. And so again, we lived through a pretty good litmus test of our strategy, and it held up phenomenally well in March. And so we were very happy to be able to help our clients kind of navigate through these crazy times. But I guess my takeaway to your question, Mike, is really, again, comprehensive approach, look at the big picture, and really try to find opportunities to protect against big drawdowns. I always talk about, and I joke a little bit about this with clients, what's rule number 1 of investing? Rule number 1 of investing is don't lose money. Or if you're going to lose money, lose as little as possible, right? And what's rule number 2 of investing? Just refer to rule number 1. In other words, it's the law of compounding. It's the magic. If you have $1 million portfolio that's down 25% in 1 year, and that means you have to be up 33% to go up just to get back to even. And so, and of course, if you lost 50% of your portfolio, you have to be up 100% just to get back to even. And those are pretty daunting numbers. And as we all know, it's a lot easier to go down fast and it's a lot slower going back up. So our goal is always to lose a lot less. If you lose, 7 or 8% when the market's down 30, well, no one's happy about losing that, right? That's still much easier to recover from when the market takes care of itself, when the market eventually recovers. So I think that's the one takeaway I always want clients to really understand, and it's that magic of compounding and keeping your assets available so you can compound and grow it over time.
Well, thanks, Greg. And I think just for me to personally, piggyback off that, it's also, hey, you don't lose money, but also it's not so much what you make, it's what you keep, right? And costs need to be factored into the equation with investments. And I'd say for a lot of our clients, taxes in retirement are going to be their biggest expense, their biggest cost. And I was sitting down with a client last week, And we're looking at the overall relationship. They had about a 50-50 split between IRA assets and taxable assets, just about ready to retire. And just through having an actual tax plan and modeling out simulated year by year through a simulated 1040 state specific, we're able to say, okay, based on not changing a thing, continue to go on the path that you're on now, and pulling from your taxable assets first, an IRA second, what their overall tax liability was going to be in retirement. And then secondly, to say, okay, if we make strategic Roth conversions year by year and at least take advantage for now of that pretty large 24% tax bracket and systematically do that up until the point that RMDs kick in, we were able to truly quantify and say they were able to save them millions in taxes over the course of a 30+ year long retirement. So I 100% agree with you in terms of don't lose money, but it's also, as I'm sure you'd agree with me as well, it's not what you make, it's what you keep, and keeping expenses low is so important, and taxes being that biggest expense. But to keep it moving on, in terms of, Jenna, I'm going to throw it to you. We've seen these high-flying stocks, the Teslas of the world, the Amazons, the Apples, where I'm sure you see all the time, whether Lido clients or others, coming to you with low basis stock, whether it's a concentrated position or not, with a significant amount of unrealized capital gains, which we also know may be going away, or in terms of the step up there. So from an estate planning standpoint, what are some strategies that clients can use when it comes to having low basis stock within their portfolios?
Yeah, we see it all the time, and it's one of the benefits of having kind of an integrated tax and financial and legal analysis of your assets. When we're dealing with a high concentration of low basis assets, there's essentially two options we pick for how to address that. One is charitable gifting. If you're going to give to charity anyway, give those low basis assets, because then the capital gains tax isn't an issue anymore. So giving into donor advised funds is one option. Charitable remainder trusts, so trusts that you put money in, you get some back over the course of the term of the trust, and then whatever goes to the charity at the end of the term, try to heavily load that with low basis assets. So charitable gifting is one of the options we take for that. And then interfamily gifting. So gifting low basis assets, when you gift an asset, the person who receives it carries over your basis. And so gifting to somebody with a lower tax rate in a year is another way to do it. If you're going to give money to your kids, let's say for tuition or something like that, do that with low basis stock. Let them sell it at their tax rate, pay a lower tax rate on the sale. If you're talking about doing that for kids under 24, there are kiddie tax issues. So you want to make sure you're being cognizant that we're not pulling it back into your tax rate. But that's one option. And then gifting, upstream gifting. So like I said, right now we have this stepped up basis at death. And so oftentimes what we'll try to do is take these low basis assets, put it in a trust for a older generation, parents, grandparents, if you have them, and give them what we call general power of appointment. That's an option that pulls it into their estate technically. They don't have to do anything. It's just technically in their estate. And when they pass away, the trust will have it come back to you. So you gift up, they pass away, it comes back to you. And the basis gets marked up to market when that happens. And so long as we keep that stepped up basis at death, upstream gifting is a really powerful tool we can use for that kind of an asset as well.
Very powerful tool. And Jenna, you had briefly mentioned a donor advised fund. Greg, can you help add some additional context? I know you dealt with that with a client recently.
Right. The donor advised fund is a very elegant, very easy strategy. People are probably very familiar with the concept of a private family foundation. The Rockefeller family and the Ford family foundation, these very well known, the Gates Foundation, et cetera. But you can create kind of your own mini foundation. And by the way, when you hear the word private foundation, it's anything but. It's actually highly public. Everything that's done, every money that's given away, assets, it's all in the public record, which is interesting. And again, I don't know, the word private shouldn't really be in the word, but it is. The donor advised fund is private, however, and you can go to major custodians like a Fidelity, and they have what's called a donor advised fund. And you can, as Jenna was talking about also, you can give away appreciated assets to this donor advised fund. And unlike a private family foundation that has to give away 5% of its assets each year to charity, you don't have such restrictions within a donor advised fund, or DAF for short. So let's say you have a very big tax year and you have a charitable intent. You could pre-fund, in effect, maybe the next 5 or 10 years of your charity by donating low basis assets to a donor advised fund in the year that you have that big income, and then take the deduction. Now, there's different limitations on deductions of appreciated property, so you want to make sure that you check with your tax advisor or check with us on that point. And you always want to make sure, if you're giving away appreciated property, you've held it at least a year in order to be able to take the full fair market value deduction. But a donor advised fund, you don't have to go away the 5%. And when you do eventually give money out of that donor advised fund to various qualifying charities, you can even call it the name of your foundation, this hypothetical foundation that's not even really in existence. So, for example, if I donated $100,000 to a donor advised fund, and then I later want to give it to a charity, I can make it anonymously. I can make it in my name personally. I could even say the Kushner Foundation, even though there might not even be a entity of that name, is making the donation to that particular 501c3 eligible charity. So very flexible, very, very powerful, especially in a year where you have a big income year and you have a charitable intent. Of course, once you give the money away to a donor advised fund, you've given it away. It's now subject to the rules of charity, and there, you just can't use it as your own piggy bank.
Thanks, Greg. And,
Sure.
and to your point, it's, with the Tax Cuts and Jobs Act, that standard deduction now for, married couples finally jointly jumped to that 24,000, no longer making it, appropriate for, individuals and families to, itemize. But to your point, front end loading, 5 or 10 years worth of charitable donations with concentrated stock would allow it to very much make sense to itemize in that given year. And you mentioned it may be a year with more income than others, but also, again, to bring it full circle to my point earlier is on Roth conversions, right? If we want to take advantage of these, lower tax rates that we know are in place today versus what they may be down the road, and we're going to more aggressively Roth convert, it may very well to make sense to then also aggressively donate some low basis stock as well. So again, conversations to have with your Lido advisor, then get in touch with John Bute, the head of our tax planning division, and Mike Burke, who's another expert in this space, along with other Lido team members. Certainly something that should be addressed now and in this year before it's too late. So,
Mike, I would just add to what you're saying. And one of the biggest mistakes that I've seen prospective clients and clients make is not thinking through exactly what you're saying, Mike. If you have a low income year, forget the high income, let's flip the flip side, and not taking advantage of Roth conversions and doing things that you're going to move money out of the, if you have a very low tax year, maybe you have a tax loss, you can do certain things that are going to make it much more advantageous for you in the future. And I just have seen it over and over and over where a client, after the end of the year says, oh yeah, I had a really bad tax year. This is from the CPA days. You had a really bad tax year, but there was so many planning ideas from a low income side. We're talking today about when you have a big liquidity event or a big tax year, but you can also, it's just as important to look at it when you have kind of an anomaly on the low end of the scale. So something to think about. And that's a mistake that I see very commonly. And obviously, as an advisor, one of our roles is to make sure we're on that. And that's why we always want to see our clients' tax returns, as they're onboarded to Lido. We want to have and be involved in the tax planning discussions throughout the year. So if there is a situation where we know that there's going to be a low income year, let's talk about a Roth conversion, talking about some other strategies.
Thanks, Greg. And to, I guess, pivot more to the investment side of low basis, highly appreciated stock, there's a lot of different angles of attack there. And John, I'm actually going to start with you, given both your investment expertise and tax background. What are some ways, in recent examples of how you addressed a low basis, highly concentrated stock position with your clients?
I think a really good way to illustrate that based upon recent experience is consulting that we've done for 2 companies that just had very public IPOs, senior executives for 2 major IPOs, and also a major technology company. So the approach is threefold, the way we handled those. One is we did an analysis of all their stock options, and we made decisions or recommendations around timing, either accelerating capital gains, deferring capital gains, or staggering capital gains over multiple years. The second thing we employed there, strategy that we employed, is we used opportunity zone investing. These executives were so focused in their technology companies. So as you might imagine, a disproportionate percentage of their net worth were focused on those companies. So we needed to get diversification to the portfolio. So utilizing a tax code change that came about with the Jobs Act in 2017, we were allowed to recognize some capital gains, move the amount of the capital gain investment into an opportunity zone investment. This allowed us tax advantages. Briefly, the tax advantages are deferring the capital gain to 12/31/2026 with a 10% step up in basis, and the investment that goes into the opportunity zone fund, if held in excess of 10 years, will actually be tax-free. So we mitigated capital gains, we created a tax-free vehicle, and we addressed legacy issues, right? Because these people they have multi-generational wealth, and now we created a tax-free vehicle to take them through multi-generations. We also incorporated charitable lead annuity trusts, and that was working closely in concert with Jenna. So I'll let Jenna go into detail, but the current interest rate environment lends itself towards this type of investment because Code Section 7520 lays forth the amount of money that has to be distributed to the charity. The remainder of the money can continue to grow, and the differential will stay within the family. So it creates a tax deduction to mitigate some of the issues that you pointed out, Michael, but it also allows for some of the money to benefit charities, which of course is important for the philanthropic concerns, but also for legacy concerns, because a disproportionate of the balance will remain there for future generations. Jenna, could you just touch upon some of the work that we did together on CLATs?
And so the goal with a CLAT is you put money into it now, it pays out to charity over the term. You get a full deduction the year you put it in. So let's say you put $100,000 into a CLAT, your rate would otherwise be 40%. You're essentially getting to, your AGI comes down by 100,000. You're paying 60,000 to give a $100,000 donation to charity. We spread that $100,000 over the term. And with CLATs, what's really powerful is we can have the amount paid out to the charity increase every year. So we start with this tiny amount that goes to charity, leaving more of the corpus to grow at a higher percentage than that AFR. And then if we just give a little bit more every year to charity to try to equal the number we gave at the beginning. So that $100,000 plus the AFR. So I can actually share my screen to show you exact numbers here. So looking here again, compliance. If you put $100,000 in at the beginning, you get that immediate deduction. And we're assuming here that the money is gonna grow at 5%. We're having the payments grow at 20%. So the first year, the charity is getting about $569. By the last year, they're getting, pardon?
Can you zoom in a bit?
Absolutely.
Thank you.
So we put in that $100,000 and let that grow over time, that 5% growth. The payment that goes out is growing faster. So we only give this tiny payment the first year, huge payment the last year, and we keep all that extra growth gets to stay in the CLAT and then get passed on to your beneficiaries at the end of the term. So using this example, $100,000 in 5% growth, you're giving $106,000 to charity because that AFR is so low. It grows a little bit every year. But $129,000 is going to your beneficiaries, pulled out of your estate, free of any kind of transfer tax or using up any of your exemption or anything like that. So when we have that AFR so low, when the amount that needs to go out over the years is only a little bit more than you're putting in, we can grow the assets more. We get to leave a bunch to your beneficiaries without having, whilst also getting that charitable deduction at the beginning.
So Jenna, correct me if I'm wrong, but I think that's just another example of strike when the iron's hot, and that specific opportunity that you just walked through is, due to the nature of the current interest rate environment, which is actually another topic that we'll touch on here in more detail here shortly. But something, again, bring up to your Lido advisor who can direct you to Jenna or with your current estate attorney for us to speak to further on, because it's very likely, interest rates can't go up or there's really no other direction for them to go from here other than up, right? So, but specific on the investment side as well, I don't want to get away from this. Greg, I'm going to throw it to you. So we talked about some more estate planning strategies, qualified opportunity zones as a way to help divest a concentrated stock position. What else comes to mind to you in terms of the way Lido will approach a concentrated stock?
Well, Mike, there's so many ways that you can really address it. And one of the ways that we've been doing this for a number of years for our clients with concentrated positions is through the use of options. And we've been doing this for concentrated positions as well as just general stock market exposure. I think maybe we'll just start first with stock market exposure generally, and then how we would do it individually for a specific name. So let's assume you had a liquidity event, or you're sitting on some cash, you want to invest in the stock market. However, things are, as we talked about earlier, things are difficult, markets are high. You're thinking, oh, as soon as I invest, that's the next day the market's going to drop down. How do you kind of get around that? We came up with this concept called the Lido cap and cushion trade. And and many of you are, I'm sure, very familiar with this who are longtime Lido clients. But to me, it just is one of the ways that we, I think, differentiate ourselves from, so many of our competitors who go back to that basic 60-year-old, set it and forget it, modern portfolio theory. So as you see on the screen here, the concept is this is for a trade that's a little bit over 1 year. Typically, we do them for a little over a year. Why? Because you get long-term capital gains rates. Again, as a former CPA, I certainly understand income tax, and we want to always try to be as tax efficient as we can. As I always like to say, we don't want the tax tail to wag the dog, however, because we don't want to just do something for tax reasons, but we want to do something and take advantage or understand how the taxes impact it. So let's look at the schedule here, or the screen that is on showing here. So let's assume this is a 13-month trade, and the concept is a little over a year from now, the market is up slightly over 10%, you make that amount. So if the market's up 5, you're up 5. If it's up 8, you make 8. If it's up 10, you make 10. However, if it's up 12 or 13 or 15 or 20, you still only make basically a little over 10. Now you go, well, why would I cap my upside? That doesn't seem very smart. Well, the reason is you basically are kind of paying for that, you're getting a protection for giving up the upside. You're being able to basically obtain a downside buffer, as we call it. And this instance, it looks like about 18%. So instead of a little over a year from now, the market being up, let's say, for example, it's down 10%. Well, you're actually breaking even. You're down 0. If it's down 15, you're down 0. If you're down 18, you're still down 0. But if it's down 20, in this example with a downside cushion around 18, you would actually be down only 2. So remember my rule number 1 of investing, the market's down 20% and you're down only 2. It's a heck of a lot easier for you to recover when the market turns around. So again, clients really like knowing that they could invest today, and if they've got it just absolutely dead wrong, they're still going to be protected for a very sizable portion of their portfolio. And so we really love the cap and cushion idea, and we can do something very similar with individual stocks as well. But let's talk about the uncapped trade for a second, and then we'll circle back to the concentrated position, Mike. So here's an example. This is now a longer term trade. It's usually about 2.5 years. But this instance, we have no cap on the upside, but we still are providing some significant downside protection. And for example, you see in the little box here, if the S&P is up 10, you make 10. If it's up 30, you make 30. But if the market's down 10, you're down 0. And in this instance, we had about 20% downside protection. The market's down 30%, like it was in March, you'd only be down 10. Now, again, no one likes being down 10, but down 10 is a heck of a lot better than down 30. And again, you're eligible and you have more of your money available to then grow as the market turns around. So then if you take it just one step further, and we have a way of creating more than the market's return, again, these are trades that are in your account. These are not structured notes. These are not insurance products. These are things that we do directly in your account, which I think is very important. Now, there are a lot of Wall Street firms issue these things called structured notes. And I just want to make sure that everybody in the audience understands that these are not structured notes. I find the structured notes are really great for the investment banks, not so great for their clients. And the reason for that is they're very stagnant, they're very fixed, they can't be modified. Whereas our trades, if we decide it makes sense to unwind part of the trade early, we can go ahead and do that for our clients' benefit. In the structured note world, the investment bank might do it for their own account, but you don't see the benefit of it. And the most important part of it, there's no liquidity. You can only sell back that instrument to the bank that issued it, and they're going to give you a pretty steep haircut on it. Whereas when you're using options, they're one of the most liquid things on the planet. We can sell those, on a daily basis, so it's a very liquid trade.
John, I'm going to throw it to you. You want to just speak to your thoughts on the current interest rate environment, and what are some opportunities that may present itself because of that?
Yeah, I think the complexities that I mentioned relative to tax code change are analogous to the current interest rate market, right? So I think the preponderance of evidence would suggest that rates will go higher here. Rates clearly have gone up recently. My view is that there's an equal weighted probability in terms of rates going up and rates going down. US Treasuries went to fixed rate in 1929. Peak yields for the 10-year Treasury was fourth quarter 1980, 15.8%. So if you look at the trajectory of rates from 1980 today, it's basically straight down. Our trough yield or lowest yield was pre-market in March. It was just under 32 basis points, which is a third of 1% for a 10-year note. So I think that I would equal weight those probabilities. The other things that I would point out very, very briefly is technology is fundamentally disinflationary. So I think that what we're seeing on the technology side is likely to keep rates lower. In spite of the fact that the Fed is trying to reflate aggressively. The other thing I would point out briefly is new capital is likely going to gravitate towards industries and investments that are not labor intensive. So therefore, I see it very difficult to pass through inflation on the wage side. But the complexity, because of the complexity, it's important to think about potentially private investments that insulate ourselves against the idea that we really don't know where rates are going. The mandate from the Federal Open Market Committee and the Treasury is 2% CPI. I candidly don't see it. Greg, could you touch upon some of the private investments that we have where we have a predictable outcome in terms of interest rate yields?
Sure, John. And I think for many clients, you're very familiar with these. They're, we call it asset-based lending or first trust deed lending, short-term bridge loan lending. They all have kind of the same or similar sounding name. But at the end of the day, it's a situation where a client can invest in a operator, a fund that basically is making short-term bridge loans secured by real estate for fairly high interest rates, even though we are in a very low interest rate environment. People will be and are very willing to pay high rates for speed, for certainty, and for situations where they need to close quickly. So we've been doing this now for over a decade. I believe we have close to about $1 billion in this area, where we've been very consistently earning somewhere between 7 to 9% a year. And even during the height of the pandemic, these operators still were collecting their income payments, because the way they do this is they make these loans secured by the real estate. So think about it. You could invest in a corporate bond, and the corporate bond has liquidity, and you could sell it at any time, but you have interest rate risk. So if you buy a 10-year corporate bond, or let's say even a 10-year treasury, a 10-year treasury is only yielding 1.1% today. So you're going to get 1.1% a year for the next 10 years. But as John was just saying, if interest rates should go up, let's say next year, and let's say they went up to 2 or 3%, now that bond that you're holding is going to go down in value, because why would anybody pay you par value on a bond that's yielding 1 when they could go next door and buy something that's yielding 3? and that's called interest rate risk. So we want to mitigate interest rate risk, and the way you do that is you have short-term loans. So these loans are typically a year, 18 months, these bridge loans. And so even if rates were to jump, that's not really going to impact us at all because we're going to get paid back our principal and then be able to reinvest at the then now higher rates. However, we do have credit risk, right? Because we're not lending to big major corporations, the US government. And so what we do is these operators then make sure that there's enough collateral, enough equity in the property to mitigate that credit risk. So typically they're lending about 50 to 60, maybe as much as 65% of the value of the building. So let's just use a quick example. Let's say I'm buying a building for $1 million, and let's say it's only half occupied. I can't go to a traditional lender because they won't talk to me unless the building is at least 80% occupied, but I'm getting a smoking hot deal on the building because it's half empty. I buy it, I put in $1 million, and I can't go to a traditional large bank, but I'll go to one of these operators and I'll borrow, let's say 60% or 600,000. I might pay as much as 9 or 10% for 1 year. I get the building renovated, I re-tenant it, and then I go get a permanent loan from a major bank. And if you think about it, even paying 10% where they maybe could get a 4 or 5% mortgage, it's not that much money in the big scheme of things for only a year compared to having to bring in a partner or the money that they're making by buying it at a discount. So again, to me, it's all about diversification. And we like to have our clients in maybe 4, 5, 6 different operators that are making these kinds of loans in different ways. I mean, I'll give you a real life example because people always ask, well, why would somebody pay 9 or 10% when you could go to the bank? So this is a real life example from one of our operators about 5 or 6 years ago. A gentleman was buying a 3-story office building. He was buying it from a bank had foreclosed on the building, and the entire 3rd floor was vacant. And so you can do that math, right? It was 2/3 full or 1/3 empty. And he knew he was getting a smoking hot deal. He went to his traditional bank that he actually had a long-standing banking relationship with, said, I need a mortgage. I want to put down about 40%, and I need a 60% loan to value. And they said, no, it's not 80% occupied, so we can't make a loan it's a regulatory requirement. He goes, oh, that's not a problem. My company, this is one of the best things about this building, my company is going to lease the entire 3rd floor. So now the building is 100% leased, so it meets your requirement. And the banker said, well, sorry, sir, unfortunately, that lease has to be seasoned, as they call it, for at least a year for us to count that in the computation. And he goes, you got to be kidding me. So one of the groups we work with made the loan. It was actually at 10.5% with 2 points up front. And sure enough, exactly a year later, the loan was paid off. So those are the things that we love right now, especially in such a low interest rate environment. Again, you're giving up some liquidity because typically you're going to lock up your funds for at least a year, maybe longer. But to me, earning 7, 8, 9% in this world of 1 or 2% is really should be in most clients' portfolios. So if you haven't been exposed to that in the past, it's obviously something that our advisors are very, very keen on, very knowledgeable about, and we'd be happy to talk to you about. But thanks, Mike. That's one of our favorite stories about why it makes sense to be in the lending area, the short-term bridge lending area.
Thanks, Greg. And just to piggyback off that, we certainly do much more beyond just your the trust deeds or the real estate debt when it comes to the alternatives. And I know there was actually one of the audience questions on this as well, as in terms of rising interest rate environment. So Greg, you nailed it in terms of their short-term loans, 12 to 18 months, and on average, they're turning over after 7 to 10 months because who wants to pay 9% for any period of time, let alone 12 to 18 months and get it paid off as quick as possible. And so again, that continues to be advantageous if it were to be in a rising interest rate environment, but also on the middle market lending side, something that we have a lot of clients in. And essentially it's lending to middle market companies, 10 million to $1 billion in annual revenues. And it's debt that's helping fund mergers and acquisitions within the space. But the company's very strong balance sheets who in a way need bridge financing, but on a corporate level. And 99% of the loans within that fund structure and approach are floating rate, tied to LIBOR. So again, would typically have a favorable outcome in a rising interest rate environment. So a lot of what we're doing on the alternative side is focused on generating income beyond what you're going to get in traditional fixed income markets but also where there is a level of safety and protection from rising rates. What I will say is there was a ton of questions that poured in over the past hour. A lot of the questions were covered just through the topics and some of the answers from the panelists here. But what I would suggest at this point is, we've covered various topics, all applicable to changes coming for 2021 and beyond. But Jenna, I want to start with you and then work back from there in terms of, what should be the homework for the audience? What are the main 1 or 2 points that you think should be the takeaways to make sure those are written down, that is addressed with their Lido advisor and other trusted experts, from what we discussed today?
I think a couple of things. One, if you are fairly high net worth, talking about, maybe 15 to 20 per person, double that for a married couple, talk to an advanced planner now. We can help you with that. We can help strategize. Do it now, because we just don't know how much time we're going to have. And even if we have till January 1st, it's a process. It takes time. Attorneys are going to get booked up once changes come down the pike. So get that process started now. For everyone, a big part of what I do is I review old trusts. And so I know a big portion of the people on this call have trusts they haven't looked at in 10, 15, 20 years. Formerly minor children are grown up now. Lots of changes have happened. So take a look at that. We can review it, talk to your estate planner about it, and update those for the current laws, your current family situation. And through that process, we're going to be checking your beneficiary designations. Like, now is a great time to just take a look, take a peek, talk to somebody about it, and see what changes you need to make.
Hey, Jenna, when I speak on this topic in front of live audiences back in the day when we could actually do that, I always provide a challenge to the audience. If they haven't looked at their document for at least 5 years, their estate planning document, I'm going to bet them $1, and I'm going to win that dollar almost every time. And the dollar bet is that you're going to go back home and you're going to go read your trust document that you've not looked at in over 5 years, and you're going to say these words. It says that. I'm going to win that dollar almost every time, because things do change, and it's amazing how many times you look at it and you go, what was I thinking back then? So, it's really something that I think I really encourage everybody to do. And with so many changes that have happened over the last decade and how many are proposed, it's really, I couldn't agree with you more, Jenna, that now's the time to make sure you have your ducks in a row. And one of the things that I think is a real benefit of that I want to make sure that we mention to all of our clients who are watching today is, Jenna's services and John's services are included in your investment advisory fee. There's not an extra cost to talk to Jenna or to John and have them look at your situation. So take advantage of that. You're already a part of the Lido family. We want to make sure that all aspects of your wealth are well taken care of.
Thanks, Greg. And I guess while you're on the mic, from an investment side, what's a call to action? What are, timing is everything in life, right? And especially when it comes to investments. So what are some, timely thoughts or ideas maybe around real estate or single family housing, or specific like airline trades? I know you and I have worked on with some clients in the past. What are some timely actionable investment strategies?
Well, I just actually had a meeting this week with a client whose husband passed away last year, and his stock, he was a good stock picker. He had Amazon and he had Apple and he had some pretty big names, and there's some pretty large gains. And the widow is basically saying, well, I don't ever want to sell Apple because my husband loved it and it was such a great stock. They've made so much money. And what I always try to explain to clients, you need to be opportunistic, and nothing grows to, as the saying goes, trees don't grow to the sky. Nothing goes up forever. And, a big company with a huge market cap growing by 20% a year, if you just do that math and compound it out over the next 5 or 10 years, pretty soon that number is bigger than the entire stock market. So what I'm saying is it's impossible mathematically for some of these companies to continue growing at the rates that they have been growing. So it's something to be a little cautious of. So I'd say my takeaway is make sure you have an investment plan. Make sure you have, we do these capital sufficiency analysis, make sure you've got enough money to provide for your lifetime through retirement and beyond. And what I find the number one mistake that people do when they come to Lido Advisors, we look at their portfolios, they actually have too much risk in their portfolios. They're taking, and that risk might have served them well while they were younger, But if they're approaching retirement age or they're at retirement age, most likely we could recalibrate the portfolio, reduce the risk, and still provide a pretty attractive return. I know we have this saying at our firm, it's like, you've already won the game, why do you want to play overtime and risk injury? And if you've already, quote unquote, won the game by accumulating a significant amount of wealth, by definition, if you're a client of Lido Advisors, you've been successful, and congratulations, you've accumulated a lot of wealth. Again, our job is to make sure that you grow that smartly over time. So having a plan, to me, most investors just don't understand the risk that's in their portfolio. They haven't analyzed it. We have, as Mike, very sophisticated software that'll analyze different portfolios and run scenario analysis based on different outcomes in the economy. And I think that's an important exercise that people should be doing. Just be aware of what's in their portfolio and look for ways to have non-correlated strategies that will hold up reasonably well, even if the stock market doesn't. I was talking with a client yesterday who was reading, one of the so-called, Wall Street experts, and that particular hedge fund manager was saying, there's probably not going to be a good market year, for the stock market. He was touting, I think it was gold and bonds. And I'm like, I just didn't find that to be meaningful at all. And so you just have to have a plan and stick to it. And if there's opportunities that we saw, for example, in March, where we pivoted and took off some of our hedges and got more aggressive, I think you've got to be able to be ready to do that. So it's as I said earlier in the webinar, it's a difficult environment, and don't do it alone. Don't do this at home alone. Try to, you need to have professional advice. As I like to say, we're professional worriers at Lido, so you don't have to, as our clients don't have to worry. And that's really ultimately what we provide is peace of mind. And hopefully we're doing that and doing that well for our clients.
Thanks, Greg. I will say, at least for the time being, they do have to do it at home, but through at least Zoom, working with a professional like ourselves. So, but briefly, and then John, we'll wrap it up with you. Some questions just poured in specific to the cap and cushion, so I just want to briefly address that. One is, can the trade be deployed in IRA accounts? It can. Typically, as some investors may be aware, there's limitations in terms of certain types of option structures. We've created some really unique workarounds where we can actually deploy both the cap and cushion and uncapped style trades within an IRA account. Again, speak to your advisor about that. And then secondly, and just in terms of, if it's a 10% cap, hypothetically, and 20% protection, is that on a year-by-year basis, or is that over 3 years where then your annualized return is more like 3 or 4%? And so it is over on a year-by-year basis. So you could have a 2-year trade where the cap is 15%, that's going to be point to point with an annualized return of 7.5 per year, and the cushion being 20-30%. Same thing, but as Greg pointed out, a sweet spot tends to be about 12 to 18 months, so that we are getting that long-term capital gains treatment, but where you can get a 10 to 13% cap as well, targeting a nice annualized return on the way up. So John, we'll again turn it to you in terms of what are some actionable items in the areas of tax that clients should be addressing in this year?
Yeah, I think so. Since we're so short on time, I think the most important point I would make, because I illuminated the complexity of the tax code changes, we talked about the difficulty to forecast interest rates, and we tied that together with trust planning, investments, et cetera. The one thing that I would say is that at Lido, advanced wealth planning is tangible and real. I'm very proud of what we do here. From a tax perspective, our tax team will do an analysis of your previous year's tax return and generate a comprehensive executive summary to tie into your overall financial planning. And the other thing I would consider doing is talk to your advisor and get on our mailing list for our updates from the tax side. Again, I mentioned earlier, there's 75 changes since December 20th. Many of them are actionable. And as relates to what Jenna pointed out and Greg pointed out as well, meaningful changes on the estate tax side. And many people that weren't affected yesterday will be affected tomorrow. And we should all be talking about this to our friends and family also, in terms of mitigation strategies we would be executing now. So I would tie it off there from my perspective.
Thanks, John. And just to echo that point in terms of those future generations, we talk to our clients a lot about changes that occurred based on the Secure Act, and now the non-spouse beneficiaries previously being able to stretch that inheritance of an IRA over the rest of their lifetime, spreading out that tax liability. Now it's a forced 10-year withdrawal. And so that's, if a Roth conversions or contributing to Roth IRA accounts may make sense from a retirement planning standpoint, if estate planning is important and you're in a scenario where you're not going to run out of money, that raises the importance of considering those Roth conversions or that long-term tax planning, which is, again, something I know, John, you and your team works alongside our planning division in helping quantify that for clients. And again, at no additional cost, that's simply part of the service. So what I'd wrap up with is, again, great questions coming in from the audience today. If there was anything not answered, please feel free to reach out to your Lido advisor, and those questions will get answered for you. But I heard a lot of great items today in so many different areas. And whether it's going to your Lido advisor and really asking for that all-encompassing, what we're calling My Lido, and that's portfolio analytics, breaking down to individual stocks and whether we have buy and sell signals. They're doing a tax review, as John pointed to, that tax plan, and mitigating what, again, is going to be for most investors that biggest expense in retirement, which is taxes. The estate plan review, the overall financial plan, and just having that comprehensive plan that you can continue to go off of and strategically adjust, based on, who knows what we're talking a year from now about. So yes, these plans are going to continue to need updates, but you need that baseline, that foundation to work off of. And that's what we are here for you as our clients, is to be that foundation and to be the indispensable resource. So again, thanks so much for the panelists today, for your time, for the audience, for the questions, et cetera. And we're looking forward to continue conversations with you all. Again, thank you.
Thank you, Michael.
Thank you.